Good evening. Myself, CA Neeraj Attiya, welcome you all to the webcast on Internal Financial Control Framework. Convener for this session are CA Snehal Kamdar and CA Vaibhav Seth. As you all know, the Companies Act 2013 marks a major step towards raising the bar on corporate governance in India. The Companies Act has re-emphasized the importance of a robust internal controls environment by introducing the term internal financial controls and by casting specific responsibilities on the board, audit committee, management as well as the auditors. Section 134(5) of the Companies Act 13 defines IFC to include policies and procedures adopted by the company for ensuring orderly and efficient conduct of its business, accuracy and completeness of the accounting records, and timely preparation of reliable financial information. Under Section 143(3) of Companies Act 2013, auditors are required to separately opine whether the company has adequate internal financial control system in place and the operating effectiveness of such control. The Institute of Chartered Accountants of India has issued a revised guidance note on audit of internal financial control over financial reporting on 14th September 2015. In absence of any guidance under the 2013 Act, the companies and the auditors were looking for guidance and a framework to help them discharge their obligations. The revised guidance note is expected to serve as a guide to both the auditors and the management in implementing the requirements under the Act. The guidance note covers various aspects such as scope of reporting on internal financial control, essential components of internal controls, technical guidance on audit of internal financial control over financial reporting, and implementation guidance on audit of internal financial control. The implementation of guidance note would also entail setting up a robust governance framework, assessment of key risks, detailed documentation of risks and mitigating controls, strong information technologies, etc. Friends, there is a saying, if you have knowledge, let others light their candles with it. So, to enlighten us on this complex subject of internal financial control, we have with us young, dynamic and excellent speaker CA Kartik Radia and CA Robin Sen with us. I request CA Vaibhav Seth to introduce our today's speaker to all of you. Thank you.
Good evening, everybody. I'll be introducing today's speaker. Today's topic will be covered in two parts. We have two speakers with us. First portion will be taken up by CA Kartik Radia. He will be taking up the topic of deriving real business value from its effective implementations. And our second speaker is Mr. CA Robin Sen. He will be taking up the topic auditor's perspective under section 143(1) of the Companies Act 2013. CA Kartik B. Radia, he is a fellow chartered accountant. He is Associate Company Secretary, ICSAI. He is also a cost and works accountant from ICWI. He is Certified Internal Auditor. He has done his CISA, Certified Information System Auditor, ISACA from USA. He is Certified Public Accountant, USA Colorado State Board, AICPA. He has done Bachelor of Commerce from Mumbai University. Currently, Kartik is working with Pricewaterhouse as a partner in risk assurance service and helps clients implement internal financial controls, risk management frameworks and internal audit co-sourcing models. He specializes in risk management solutions like enterprise risk management, internal financial controls and internal audit effectiveness. After working for nearly 15 years in this profession, Kartik believes that there should be visible and transparent business value addition that should come out from any risk management or internal control solutions, and the delivery model should be based on business context. He has worked with some of the complex risk modeling assignments such as capital adequacy reviews, stress testing financial reviews, internal audit effectiveness, governance effectiveness reviews for banks and financial institutions and large MNCs. Kartik has worked on capital adequacy reviews, stress testing financial reviews, internal audit effectiveness and corporate governance policy. Kartik has also worked in the past with ENY WPP Group for implementing SOX in North Americas and European region for 3 years. He has worked on international assignments across geographies, including United States, UK, Canada, France, Germany, Netherlands, Greece, Spain. Our next speaker is Robin Sen, is FCA BCom. Currently, Robin is working at Pricewaterhouse as a director in risk assurance services and helps clients implement internal financial controls and internal audit post-sourcing models. In his current role, Robin specializes in assisting companies in India get prepared with internal financial controls, both in terms of responsibility of company board and management as well as the auditors. With over 12 years of experience in business risk collectorship and transformation, Robin's goal is to help business extract optimal value from their initiatives. CA Robin has worked on international assignments across geographies including United States, Japan, Middle East, China and South Asia. In the past, he has worked with Ernst & Young for over 7 years. With this brief introduction, I'll request the speakers to take over the present, but before that, as a mark of honor, we'll request CS Nehal Kamdar to present a memento on behalf of our institute to the learned speakers.
Thank you so much.
I request our speakers, Kartik Radia, to take over the session.
Sure. So, thank you, Mr. Vaibhav, for such a generous introduction. In fact, the topic that we are going to deliberate upon is one of the most important topics that we are going to be discussing today, which is internal financial controls. And the first part of this is deriving the real business value out of effectively implementing the internal financial controls, that is IFC, in which we are going to deliberate upon some of the very important elements, whether this should be a mere compliance exercise, which will be just a tick in the box, versus something that is going to really drive and add to the business value, is one of the very important points that we are going to discuss. There are some basic elements also which we are going to be deliberating upon. What is IFC, and what does it really mean? What does it cover, and so on. How is it different from some of the very important pronouncements and the legislations across the world? Then the next important element is going to be the scope of entire IFC exercise, whether it should include the operating controls, whether it should not include operating controls, whether it should include fraud controls, or whether it should include entity level controls, or whether it should really include some of the planning aspects of the business and the strategic aspects of the business, which is again a very important point from a scoping perspective. Then there is going to be approach and methodology that we are going to be discussing upon. How do we actually approach the entire IFC implementation exercise? What is the methodology around that, which is again a very important point that we are going to deliberate upon. Post which there are going to be some important questions, 2 or 3 most important questions, fundamental questions that we are going to be discussing upon. After which Mr. Robinson would take over on taking up the other part of the session. So, coming back to my first very point is whether this is something that should really add to the business value and drive the business value vis-a-vis just a compliance exercise where it amounts to just taking documentation, maintaining documentation, ticking the box, and maintaining the documentation for demonstrability to the statutory auditors, just for compliance, or whether something which should go out and add business value. So a very important point of view that we would like to have on this is that IFC being a regulatory requirement is there for a purpose, which is to improve the financial governance of an enterprise. In fact, both listed as well as non-listed. But it should not be restricted to just a tick in the box compliance exercise. This should be something that should help business achieve the financial governance objectives of having a good amount of financial discipline in terms of financial controls and financial risk management, and improving the reporting controls, the financial reporting controls, which will be around financial statements. So this together would be constituted as something which is an IFC set as we would go further into the session and as we would further upload the presentation later on for the benefit of all the participants. This is going to cover in one of the slides as we move forward is the IFC set. Now IFC set particularly is going to be largely including the financial set. But there is something which is over and above that, which is the management set. And management set would be including a lot of other things, and that is again completely optional for the business, whether to include the operational and the management set over and above the IFC set, which is just merely a compliance exercise or for a compliance requirement. So very clearly, how do we make sure that we achieve real business value out of IFC implementation? If we are going to restrict ourselves to just meeting the regulatory requirements of Section 134 and Section 143 from an auditor's perspective, then all that we are going to do is making sure that we have some of the main controls and some of the documentation and maintaining demonstrability around it. But if we were to talk about a larger context of improving the financial governance, then a very important element that comes into it is not just some of the controls around the balance sheet, trial balance, or profit and loss, or business financial transactions, but going into some of the very important aspects of the business. And I can outline one very important aspect for that, which we'll cover also subsequently, which is whether an input-output ratio is an operating control or an operating issue, or is it a financial issue, which is to be covered in IFC. And if you take a very narrow view about it, you may come up to a conclusion that it should be an operating control and not an IFC control, not a financial control or not a financial governance element. But imagine of a company which is into manufacturing, which is into, let's say, a chemical business or a manufacturing business, where about, let's say, 70 to 80% of the cost is raw material cost, and it may not be virtually possible for every time or every quarter to go out and do a stock take and a full amount of physical verification, or it may not be possible to do even a monthly physical verification in some scenarios. Annually, of course, we will have to do once in a year at least physical stock take. But if that is the case, and practically and from a feasibility standpoint, it's not possible to do 100% physical verification, then the reliance on input-output ratio is far more in a situation where we are not doing a 100% physical verification every quarter, for example. Now, in which scenario input-output ratio is actually to be used to arrive at what is a consumption figure that is to be charged to the P&L account. And if we say that input-output ratio is an operating control and not a financial control, then the entire consumption and the entire consumption value and the closing stock value, which is dependent upon the input-output ratio, will have an implication. So therefore, while input-output ratio could be an operating element of the business, to have adequate control over it is a financial element and should be a part of IFC, although it has an operational, it is of a nature of an operational element of the business. So this is what we were talking about. Is we are not saying that we need to go about doing, let's say, thousands of controls to include them to drive the real business value. It may be mainly financial controls, but there would be about 10 to 15% of the operating controls that should be included. And when we say 10 to 15%, there is no big thumb rule science on this, but we are just saying that if there are 10 to 15% of the operating controls, then these are going to be important. We call them as a key operating controls that have to be included in the IFC set, which is to be included in the IFC set. Now very clearly, if we go back to look what Institute's guidance note, the revised guidance note which has been issued in September 2015, very recently, that has very categorically sort of re-clarified the term IFC, which is internal financial controls, over financial reporting. So while the basic focus is going to be around the financial controls, but if we largely look at the definition of the internal financial controls, and if we look at the spirit around it, and while we earlier had clause 49 already, which also defined the term, because it was related to financial reporting, it defined the term internal controls over financial reporting, which was very, very clear. Now that there is a different term which has been used in the Companies Act, which is internal financial controls, it is therefore important to take a little more holistic view, and that is that 10 to 15% of those operating controls, 10 to 15% of the total controls that we are talking about in IFC, those which have a real impact or a potential, those which have a potential of causing you a financial impact into the balance sheet, P&L, etc., are going to be very, very important. They have to be included in the IFC set to really help you drive the business value. Now, the other dimension to this which has to be noted is, earlier in the clause 49, the requirement was largely for the CFOs and the CEOs to ensure that there is adequate internal controls over financial reporting by way of CFO and the CEO certification. Now that responsibility has been completely casted to the board of directors on one side. That board has laid down adequate internal financial controls. So while the responsibility has got shifted, a lot of accountability has got also got developed at the board level. While of course the owners of the controls may be sitting in the business as a part of different parts within the management group, but the board has to ensure that there is adequate implementation of internal financial control framework. So it is very important that board is satisfied about it, because they have to ultimately take the accountability and put it as a part of the director's responsibility statement for the listed companies. So it is very, very important that board gets involved into this entire process, and we have seen this, that the moment the responsibility is a part of director's responsibility statement as an accountability of the board, the whole gamut and the whole spectrum changes to a very different level. The importance and the seriousness that it has brought in the Indian context is very, very different, because it is the board which has to deliberate and ensure it as a part of their responsibility to ensure adequate compliance, and therefore be adequately satisfied itself. They might have to go into some of the micro elements of non-compliance themselves before getting satisfied and before reporting on internal financial controls. So which is again a very important element to drive the real business value, where the board has become accountable. The third very important element is to ensure that there is adequate control ownership given to the different people who are going to own the controls within the entire management group. Again here, it's not going to be the finance team alone, because if you say it's going to be only finance team and the financial controls, and therefore only the responsibility and accountability of the finance team, which has been the case so far, and finance team becoming the key owners, only the finance team becoming the key owners, then there is again an issue there, because a lot of times we have seen that finance department, while it acts as a very important back office for ensuring adequate and timely preparation of financial information, and of course in many instances also making sure that there are adequate controls in place, financial controls in place. But many a times there are these controls which lie beyond the finance team, and they sit into different parts of the management and different parts of the operations team where the control actually resides. And in that scenario, it is very, very important that finance team, while will drive this program, but the ownership is shifted to different parts of the management where the programming is being driven. Just to give you an example, when we talk about entity level controls, in entity level controls, there would be certain HR policies, and we will come into some of these technical parts of the entire framework and the components a little later. But let's say an HR control or an HR policy on code of ethics. Now, while HR would play a very important role in administering the entire code of ethics policy, it is not necessary that any of the people in the finance team would be involved in the code of ethics policy. But the entire internal financial control process will rely very heavily on the entity level control policies. So while the ownership might be there with the HR team, it is very important that ownership is given to them. They are being made adequately responsible and aware about it. But the driving factor may remain in the finance team, and the ownership may remain with the HR team. And therefore, when you have to really drive the business value and achieve business value, the ownership will have to go beyond the finance function into the real operating parts of the business. And again, to go back to my previous example, which is of input-output ratio, and in which also we said that input-output ratio, there is nothing that a finance department can do to improve an input-output ratio, because they are not involved in the manufacturing process. They can only report it, they can go for variance analysis about it, but there's nothing that they can do. The moment you shift this responsibility of input-output ratio to someone sitting in the plant and ask them to basically ensure that there is a proper reporting around the proper gathering of the information and proper reporting of the information around input-output ratio, the ownership shifts to the operating parts of the business, and that's very important again to drive the real business value. The third important element here is to achieve the ownership of the internal financial controls. It is important to use a proper framework of control self-assessment, and this is only going to reiterate or reinforce what we have earlier said, which is ownership of controls. Now, how do you reinforce the ownership of controls? By ensuring that there is a control self-assessment framework. In the control self-assessment framework, what is important is, depending upon the criticality of controls, all the individual elements of controls are self-attested, self-assessed and self-attested by the business teams, and they are reported in a particular frequency to the management, that is the CEO and the CFO. And by doing this, what is being ensured is that the ownership is actually reinforced. When you have to reinforce the ownership and you want people to take responsibility, it is very important that you do self-assessment programs. Otherwise, all of this will remain in the paper. So if you have to really drive the real business value, the way to do it is to do it through a control self-assessment framework. And you may use a tool for control self-assessment, because you may want to use a technology that will help us do the control self-assessment across the business. But that is again an optional thing. There is nothing mandatory here that you have to use a tool. It just drives the efficiency and the way of doing it. So that is another important element, which is for driving the real business value. Again, just to take this concept a little forward, is to do it in a little bit more formal manner. When I say formal manner, what I really mean is there is a complete reporting spectrum that goes right from the process owners to the board. And basically, through this reporting spectrum, an important point to be ensured is that at every level there is an independent line which is giving the comfort. So, just elaborating this little forward. Suppose we are talking about the level 1 line of, so I would make a reference to COSO 2013 framework, which is also very important and relevant here. And COSO is an important internationally well recognized integrated internal controls framework. There are some very important references to be drawn. Not that it means the whole IFC means that we have to completely borrow what COSO is saying or do everything what COSO is saying. But it is important here to draw some references, some of the conceptual elements from COSO framework. And that is, let's say we have, when we said that the ownership has to be shifted and reinforced through a control self-assessment, the ownership has to be shifted to the process owners, which is the first line of defense. That is the people who are actually running the controls. Let's say, for example, in the case of input-output ratio, the production controller who is actually running the control. He is the one who is the owner of the control, which is input-output ratio. So, the owner of the control, and there will be various owners of the controls across the business. So, the owner of the control will do a self-assessment and will report on the self-assessment and will declare whether the control is operating, is first of all designed, and whether it is operating effectively or not. And that goes in a consolidated manner to straight the CFO and the CEO. Now, so CFO and the CEO is the senior management component, which is from an IFC perspective. CFO and the CEO are the ones who would take the overall accountability for the effectiveness of the whole program. While the responsibility is still statutorily for the directors to give a director's responsibility statement, but directors are not going to participate in the day-to-day business. So it is important that the whole effectiveness of the program is driven by the CFO and the CEO, which is why the owners of the owners of different controls will report about the effectiveness of the controls to the CFO and the CEO through an IFC set, to the set of controls, whether they are operating effectively or not. And while owners are reporting as a part of control self-assessment, there is a very independent line of second line of defense, which is the controller function. And mind you, the second line of defense is not the internal audit function. The second line of defense is the controller function, which may be sitting in your finance function or may be sitting in different parts of the business, but they are defined as a second line of defense. The second line will independently report to the CFO and the CEO that they have got, whether the controls are operating effectively or not, which is how the CFO and the CEO would get an assurance on the effectiveness through an independent line of reporting. So process owners most likely would tend to say, yeah, things are operating, but that is not what the CFO and the CEO should believe in. They should really look for a second line controller assurance, which is very important. Over and above this, as we go further, the CEO and the CFO will have to report to the board. But similarly, as we spoke about second line of defense for CEO and the CFO, there is a third line of defense which is there for the board. So while board is getting again the CSA results through the CFO and the CEO in a consolidated summary manner, there is an independent line of internal audit which reports to the board whether the controls are operating or not. And therefore, again, to derive a real business value out of this whole proposition of IFC, we recommend a very important role of the third line of defense, which is the internal auditor's third line of defense. The role of internal audit to include IFC testing as a part of their overall scope of work, which is how board will get an independent assurance. Any which ways, internal audit department is supposed to be an independent department. The moment you give them this responsibility of additionally testing the IFC set, they would tend to be able to give an independent assurance to the board, and which is again a very important point of view from our side to ensure that we really drive and maintain the business value that should be derived out of this. So this is the first part that we wanted to deliberate and highlight on IFC. There are some more specific elements which is from IFC, some of the basic elements, and that is that this enables and once again reiterates and reinforces the discipline of internal controls. While we are talking about internal financial controls, as I already said, a portion of operating controls, which is not too much, but still a portion of operating controls will be covered in it, and therefore the whole discipline of internal controls tend to be improved. There is another important element here on the basic side, that this whole program, actually when it is driven by the board and there is a proper transparent reporting to the board, it helps to improve the transparency from the management to the board. So while the most paradox situation is that management is running the business, that's what the whole company form of business is all about, corporate form of business is all about, that the ownership and the management is different, and directors are to be acting as fiduciary agency on behalf of the shareholders. So ownership is different from the management as far as corporate form is concerned, but directors have to act on the behalf of shareholders in their fiduciary capacity. But they don't know the business because they don't run the business. They meet, most likely, they would meet in a quarterly manner, or maybe at the most maybe once in 2 months or so. And there are also there's also a component of independent directors. Of course, they are independent, and since they're not involved in the executive functioning of the company, the paradox situation is that the responsibility is casted on the directors, but the actual operating responsibility of any financial control or an operating control can only be with the management, because they are the ones who are driving the business. But you've made the board responsible and accountable, and because of which the whole transparency to the board has to be improved. If it has to be improved, the whole program scope has to be defined. After defining the program scope of internal financial controls, line item wise, it is important to give independent assurance to the board through a third line independent testing that I've already mentioned. And this is an important element that needs to be discussed in the board meeting. Not that it is, again, as I said, it's not a tick in the box whether done and not, but the board actually goes into different elements of failures, if at all any, or further improvements which have been noted by internal audit, to further ask questions and to further give directions at the board level. So that is another important point to improve the transparency to the board. Being transparent to the board, the program has to have a proper systematic and detailed back-to-back detailing and supporting. It also, again, to drive a very important business value, the moment something has to be reported from the CFO and the CEO to the board, it is very, very important that the visibility of the CFO and the CEO itself into the business improves because of the whole IFC reporting that they have to do in a transparent manner to the board. So it is important that the visibility of the senior management into the business aspects of the control is also improved, and that can be improved again if we follow a very systematic, detailed approach towards the implementation and towards its